Hi, I'm Tom Grafeo with Dove Investment Research and Management. Thanks for joining me today for a few minutes to go over what we talked about recently at our kickoff meeting for 2019. Had a great opportunity to share with our clients, had a great turnout on a Saturday morning here recently in Irvine, and really wanted to just take a minute for those who could not make it and ask for some kind of synopsis of what we talked about. I'm going to try and do that over the next 15 minutes or so. I'm going to try and make it 10, but I have a history of making it 15, so we'll try and do the best I can at this point, okay? So I want to just do a little bit of a review about what we happened in 2018 and what we have planned for 2019, and then some of the economics around that. So here we go, okay? The first thing about 2018, for sure, we know is that we feel blessed. We serve some of the most wonderful clients in the world. We are just so happy and so blessed. Thank you so much for being part of our group and letting us serve you. The company is growing and we're doing fine, and that is certainly through the generosity of referrals. The referrals that we've been getting from clients have been just amazing and great fit for us and for them, and we're changing people's lives. And that's why we know, as it says here, we believe God is using us to His benefit, and we are just humbled by that and just really are pledged every day to doing the best job we can in that regard. So yes, it is a wonderful, wonderful opportunity. I love coming to work every day. Over the last couple of years, we've been recognized. When I first established Dove as a standalone organization in 2016, that same year we were recognized as having one of the, very quickly we're recognized for having one of the best financial planning firms in Orange County. We got a 5-star award in Orange County. Then again in 2018, we were recognized for being one of the best firms in Orange County as a 5-star wealth manager, and we were just very honored to do that. When you go through the process, there's a number of steps to become a 5-star wealth manager. First you have to be nominated, and then there's a complete regulatory and compliance review, making sure that our business is running clean and that there are no complaints and there's no big issues. There's a submission form and process I have to go through. I think it's about 10 pages of stuff I have to submit and different things. And then there's an evaluation that they do on their inside, and then they talk to even LPL, our broker-dealer, make sure everything's clean with LPL, that we have run good practice. And then there's a finalization. Really, in Orange County, only about 7% of the people who are nominated. In 2019, there were 2,469 people considered, and there was less than about 170 people that wanted, something about 7%. So we were really honored to be recognized as one of the best firms in Orange County for that, and we are deeply grateful for that. But I'm happy to announce as well that we also won it again here in 2019. So thank you to all the clients, and thank you to all the people who nominated us, and thoughtfulness and all that. It is just a really great honor to continue to be able to earn this award, and we are pledged every day to continuing to do that. So we have some good things happening here at the firm, and want to continue to do that for the benefit of God and benefit of our clients. So what do we have planned for this year? What's the big thing for this year? We got a little bit of a change. We're going to continue to have LPL, who's been our 10-year business partner. LPL is our broker-dealer. They've been a great partner for the last 10 years. But we're going to change to what's being called a hybrid office. Hybrid, we will maintain our primary relationship with LPL. It's been a great partnership, but we're going to expand to allow for other custodians as well. We may add things like Charles Schwab, Fidelity, TD Ameritrade, and Interactive Brokers. These are all things that are possible, and if you have money there and want us to manage it, we can continue to look at that as well and bring that on our platform. And the other thing, as a research analyst and as a guy who spends a lot of time thinking about economics, the other thing is I get access to the research and trading platforms of all these companies, which is tremendous. Now, believe me, I think I get a lot of great research. Last week I was thinking about it. Last week I started off the week with dinner with Goldman Sachs. It was a great dinner because I got to sit in a small group with portfolio managers from Goldman Sachs and really dive into a couple things that were really interesting and think about. Later in the week I had lunch with JP Morgan, again small group setting, and got a chance to really dive into some of the economics and some of the things and some of they were studying behavioral finance, a new subject for a lot of folks, but something I really wanted to understand. So we have good research, but being able to have access to more tools and more platforms, never a bad thing, right? Let's jump into some research. This is JP Morgan's. The next following slides are all from JP Morgan. I think that they have the best explainable slides from this point. So that's what we'll see. Whittle it down to a few. These are some of the economic thinkings and some of the considerations I have for 2019 and your portfolio. Okay, this chart goes back to 1997, and you can see a nice rise all the way through Y2K, and then it comes off. And it's really two events, right? The Y2K, and then there's the 9/11 tragic event beyond that. In 2003, kind of hit bottom, and then we built out of it, and then it's always going to be easy to spot 2008 on these charts because everything changed in 2008 all the way down. And we've had this very big run since then. It is completely normal to think, okay, we have these waves. These waves are kind of, you know, if not normal, they're extreme, but if not normal, that there are times when it's volatile. But this has been an extraordinarily long run. Is this normal? Are we overpriced? Are things? Should we still be in a good place at this point? So let's look at the S&P 500. One of the core things we look at is called the PE ratio, the price to earnings ratio. It goes back 100 years that people have been looking at PE ratio. It's one of the oldest metrics. You can see going into Y2K, the PE ratio was very high. You can see after 2008 it was very low. There's a kind of median line here. And if you look at it right now, the PE ratio, we're actually not far off of a kind of a low spot. We're not overvalued by any measure. We're certainly not near Y2K levels, and we're doing well as far as being relatively cheap to other metrics. So the price earnings ratio looks good. That's a good indicator. The other things that are important to look at on this page is, okay, this is S&P 500 companies, the biggest 500 companies in America. How's their operating earnings? Are they earning money? Are they making money? And again, you can see growth. This is from 2002. You can see growth all the way. There's one hole, right? 2008, and then it continues to grow. But it's easy to see that right now, operating earnings are at one of the highest all-time numbers ever, which is great for companies. Companies are earning money, that's really good. How's our profit margin? Well, again, profit margin you can see climbing, the 2008, and we climbed out of that. But profit margins since 1992 are an all-time high. So these indicators are really, really strong, right? We're not paying too much by price earnings measures. The companies are earning money, they're earning the most money they've ever earned, and the profit margin is totally solid and good. So this all tells me that the stock market, by core metrics, by core things I would look at, are not overpriced at this point. But you look at what happened last year, and we had a negative year. I really believe that has more to do with a couple of tweets and some bad comments by some very important people. Mr. Trump tweeted about I am tariff man on December 4th. If you go back and look at a chart of the S&P 500, and you look at December 4th and what happened the days before and after that, and 30 days after that, you will see a significant change in the attitude of the stock market. Around December 12th, I believe it was, Fed Chairman Powell went to the New York Economic Club and had a talk with folks. He kind of went off script, I think is what everyone's been calling it. He did not look at his notes, he went off script, and he kind of just freelanced his comments. And the market turned around 800 points that day and went negative. It was a very bad day for him, it was a very bad day for the market. And between both of them, they really took most of the wind out of 2018. Because in the fourth quarter, blend is the way to look at this, 13.5% down in the fourth quarter, leaving us with a negative 4.4 for the year. Until this down 13.5% from the couple comments and some other things that were happening, China trade stress and all the other things that were going along. We actually had a pretty decent year going into it, and we've certainly rebounded a lot since January and since Christmas, and that has been a big thing. But across the board, you can see that there's a lot of negatives, not only certainly in fourth quarter 2018, but resulting in a 2018 overall negative across different areas. Let me break this down for you just for a second here and to take a deeper dive. Financials, right? Fourth quarter, financials were down 13.1%, and in 2018 overall they were down 13%. Those are the big banks and big financial companies. The other highlights on here, one of the best performing sectors was real estate. It was down 3.8% in the fourth quarter and 2.2% overall for the year. So that was actually kind of the best segment to be in. Clearly the worst was energy. Energy, fourth quarter down 23.8%. Gasoline and oil prices dropped significantly. They went from like $80 to $40. That really translated to real big headwinds, and so we had it down 18% overall. So when you can go all the way to the end, the S&P was down 4.4% for the year. That's a big surprise, if you want to say that, because there's so much good economic news. But again, when you look at this, and I think when you look at it over going to be a 3-year time frame, you're going to see a V, and you're already seeing a V, that it was a V, and it was December was this significant V because of the things I mentioned already, the comments and some of the other things that are happening. Gross domestic product, are we making more stuff? Is the economy growing or expanding? Gross domestic product expands, it's good. We are expanding. You can see a nice upward trend here. The economy is expanding. More expansion means more stuff. But my thinking over the years has always been, and I'm one of those believers, that everything, this big block here is the consumer, right? This is all the components of GDP. So the GDP is growing. These are the components of GDP, right? 70%, it's exactly 68%, but let's call it 70% of GDP is contingent upon what's happening with the consumer. Government spending is 17.2%, and then investments ex housing is 14%. So really nothing is more important than the consumer when you break down the major components of GDP. The consumer's happy, the economy's going to expand and do well. Well, let's see how the consumer's doing. We're going to break down these two slides here and take a deeper dive into that. This is household net worth, okay? This goes back to 1990, and again, except for 2008, you can see a pretty great trend, and particularly all the way through here recently. So household net worth, meaning that the individuals who are, the mom and pops, everybody looked at in America, the net worth of households is growing. When you have more money or feel like you're becoming wealthier, that's a really strong thing, and that's a really good thing because you're willing to spend money and you're willing to continue to grow the economy and do things and take on other things. So what's the other part of it? Okay, so your net worth is going down. One of those components can be debt, right? Now you can see that this is from 1980. Debt kind of cycled around. It peaked in the fourth quarter of 07. What happened in 08? We know that. Boom, right? Everyone decided to get out of debt and eliminate all the debt, and interest rates went down and made it much more affordable for people to afford debt and get out of it. So now we actually have the lowest debt levels going back to 1980 that we've seen in the United States. That's good. Again, if you are building your net worth and have less debt, that's a really good thing for the consumer, and the consumer drives so much of the economy. We're going to break down a couple slides here as well. I'm going to break down the federal debt. This is the federal net debt. This is the headwind. This is the one that scares me. This is the one I'm concerned about. I'm a traditionalist, right? I'm an old school traditionalist. We have borrowed, if you look at this goes back to 1940, so it goes back a long way. So you don't have to be a historian to know that from 1940 to 1948 that we were willing to go all in on World War II. And the government spent as much as they could to turn the world around from World War II. And thank you to all the brave men and women of that era who are now leaving us. But that was an amazing time. And you can see how the overall debt of the United States government as a percentage of GDP went down and kicked along. But again, here's 9/11 and here's 2008 and upward. So our debt has taken a significant rise. It's not like it was here from the mid-70s to the 90s. It has taken a significant rise as a percentage of GDP. And we just saw GDP is growing. So it's not a GDP problem. It's that the government's spending too much, and at $22 trillion, this is a problem. And this is the only thing that really concerns me in the economy in the big scheme of things. But let's take a look at other good news. Unemployment and wages. So unemployment from 2009, which was a peak, has been that more and more people have jobs, so the unemployment rate has been declining. That's great. More people have money, more people have net worth, more people have jobs. This is all really positive. Core, good, positive news. And here you can see towards the end, and certainly since 2016, that you can see that there's more and more wages are coming into this, so people are making more money in the process. Great news for the economy. This is interest rates. This is one of the other ones that concerns me. So we've had a lot of good news. We have a headwind with the amount of national debt that we have, but we all owe that. We also have a bit of a headwind with interest rates. And you can see, again, here's 2008, when the problems hit. The Fed dropped interest rates nearly to zero and have kept them there, trying to get the economy to come back again. And now we've started this process of raising interest rates. There's no doubt interest rates should be higher, probably somewhere in the 4% range. So we're not completely there yet, but the Fed's going to be really slow at this point. For technical reasons, I can say that they are disconnected. Our interest rates are disconnected from the rest of the world. Our rates are higher, creates demand for the dollar. There's a lot of things that go into that, but I think about that in terms of your portfolio. But this is a headwind overall, and this scares the market a lot. So you have to be thoughtful of that. So let's talk about the United States versus the rest of the world. So we saw this chart earlier. The gray line is the United States. The blue line is the rest of the world. And you can see we kind of tracked, and the world and the US tracked very well until 2008, 2009. The United States kind of grew out of it, and really about 2012, the United States grew out of it, and Europe and the rest of the world really has not grown out of the same thing. Do you want your investments to look like this or like this? So since basically around 2013, 14, somewhere in that range, I've not been a big investor in international. I've not been a big believer in international investments. They've put on very draconian measures on their banking system. You constrain capital like they are doing in Europe and a lot of other places. If you constrain capital, you constrain growth, and the evidence of that is here. So yes, I'm an old school capitalist. That's what I've been trained as, and I believe in it, and I see the evidence of it. It's just more of a mathematical thing for me. Numbers of U.S. companies listed. Okay, this is one of the last slides here in this series. But I include this because it's a fascinating thing. So we see good news. The economy's growing, people have more money, there's more household wealth, there's more stuff. So there's more places, there's more money there's more money out there to invest and do things with. Fine. But the number of companies listed in the exchanges have been declining. There's less companies. Why? Companies merge, companies go out of business, right? Some companies go out of business, some merge with each other, and then some of them are bought out privately. So there's this very real trend. I don't have the complete answer on this yet. This is a fascinating thing for me to think about and think about how it might imply in portfolios. But this isn't something a lot of people are talking about, but it is something that I think is important because we've gone from 8,000 to, about 4,000, about half the companies in 20 years. That's something to think about, that there's half the companies to invest in over the last 20 years. This switches our thinking to asset allocation. So we take all that stuff we just learned and we think about how do we want to allocate. There's stocks, bonds, and alternative investments, right? So stocks are equities, fixed income are bonds, and alternatives are things that don't belong that don't behave like a stock or a bond. And we break out the equities into growth and value. This is the meatball. I've been calling it the meatball for more than 10 years. It goes back all the way since I got my SEMA in years and years ago. And then fixed income. And this is something I've always tried to use to explain things. There's higher risk and lower risk, and there's non-US, which means it's a higher risk category, and there's US-based investments, which are lowest. The lowest risk category certainly is bonds and cash. So how do you allocate among all this? How do you allocate a 401k? How do you allocate your account? How do you think about all this, given everything that was done? That's where I come in, and that's where I think that I can really be of service and help for individuals and families and facing many challenges along the way. This is some of the stuff that we covered at a kickoff meeting. I would love to sit down with you, explain anything. If you want to ask me any questions, if you want to go over stuff, I'm happy to do that. Our phone number is 949-276-5800. Would love to have a conversation, a meeting, a cup of coffee, whatever it is. Also, if you like what you saw here and you want to share it with somebody, please consider sharing it. We would love to spread the news and spread all the good things that are happening at our firm and some of our thoughts going forward. So thank you for allowing us to serve you. Thank you for what we think is going to be a great 2019. It's already got to a great start. It is a pleasure working with all of our clients, and we hope that we have a chance to see you here soon. The next big thing that we're going to be working on is what we call the Summer of Love. We call it that because we love to see our clients. We'll be looking forward to sitting down with everyone individually for an in-depth review, see how they're doing, and where we can make adjustments and make things happen for you. So be ready for a call from us for a Summer of Love. Thank you so much. Have a great and blessed day.